There are always contradictory voices about what will happen next on Wall Street. Typically, the bulls who expect an optimistic future shout the loudest because they have something to sell. And yet, we often should listen to the contrary impulse from the bears, those who are predicting a downturn. Right now, the indications are that we may have an economic crisis imminent in the coming months. So today we're going to look at some of the signs of why.
Hello viewers, today we're coming to you from New York University International Relations Department. I'm with Dr. Nolt, Senior Fellow at the World Policy Institute. So in our short video, we touched upon the issue of financial crisis. And this time I'd like to a little bit dive into more in detail and discuss the financial crisis, the one that we're expecting, upcoming financial crisis. So there are always so many supposed experts that giving contrary predictions about the economy. At this point, I'd like to ask, who should we believe, really?
Well, that's a big question, of course, always. And part of the problem is with anything involving financial prediction, there's a lot of money to be made.
Right.
So there's always people who put their money where their mouth is, so to speak. That is, they have something to sell, or we could turn it around the other way and say they put their mouth where their money is. That is, they already want you to buy in a certain direction or buy a certain idea, so they're going to put it out. That's the big problem with listening to financial advice, is it's usually self-interested. You have to be able to read the signs somewhat on your own, but one of the things to be clear about is that there is a business cycle, and crashes are eventually going to happen. We've been going a long time now without one. We're sort of overdue for a downturn, and now there's a lot of specific signs, which we can talk about today.
Absolutely.
About why we might be close.
Right. Well, recently several of the biggest banks actually have been making bearish predictions and warnings. So are you saying that these banks, that tells us that these banks are themselves likely to be bringing about the crisis? What is their benefit from doom and gloom?
Yeah, well, that's an important question, because typically, of course, most of the time when we listen to financial advisors or pundits or bank advertisements, they're giving a very rosy picture. You know, invest for the future and look forward to ever rising stock prices and so forth. So when banks turn negative in their public pronouncements, that's actually signaling something about their own strategy. That may mean that they want people to become more pessimistic, right, because their own investments are tending to bet on a downturn of the economy. And without getting into all the complexity of how they do that, if they expect a downturn, they can also help bring it about by tightening credit. Because whenever credit tightens, whenever it's harder to borrow money, business will slow down.
Right, that's a very interesting point. Since we started to talk about bear and bull dynamic, I was always curious about bear's position. So that's why I'd like to ask, could a financial crisis occur anytime powerful bears want to create one, or are there any sort of like circumstances that must fall in, to make crisis happen possible?
Well, there's always a strategic interaction between bears and bulls, but a general crisis requires specific conditions. It isn't possible just to bring it about at any time. Mm-hmm. One of the conditions that's required is that there have to be a lot of people who have borrowed aggressively in order to expand during the boom period. The bulls. The bulls
Right.
create the opportunity for the bears. In a sense, they're the food for the bears. And it's only because you've had a lot of bullish expansion, debt fueled, that all those indebted, players and businesses are themselves vulnerable. All right, and that's the backstory. That's what creates a condition. It's sort of like you can't have a forest fire without the dry wood. You have to have the fuel. The fuel in this case for a crisis is a high level of indebtedness that's going to be vulnerable to one of two things or both. One is a rise in interest rates, which will increase the cost of carrying debt, and the other is a fall in the revenue that you're earning from however you invested that borrowed money. So if you invested in building a business, if you invested in buying securities or buying stocks, whatever,
right.
if you're earning less money from what you borrowed, you still have to pay back that money. It becomes more problematic. So you start to see your earnings fall. You might try to liquidate, you might try to sell in order to get out from under the debt, and that's what creates the selling pressure.
Right.
It tends to accelerate a crisis.
I want to also ask a little bit about trade. why do problems in trade increase the likelihood of financial crisis? I want to see the link. I want to hear a little bit about link between financial
Yeah,
crisis
that's very important now because we probably have the worst conflict in trade since the end of World War II. And they're linked because all trade is financed. I mean, most people don't realize this, but nobody does international trade on a cash and carry basis. They always do it with financing. And in fact, one of the bread and butter businesses for most big financial companies is financing trade.
Trade, yeah.
So if trade has impediments, then a lot of financing is going to be in jeopardy. For example, somebody wants to export, let's say, clothing from Shanghai to the United States. They have typically borrowed money in order to do that business. They borrowed money on the expectation that the business would work out, that they'll be able to sell what what they're exporting, that they'll be able to sell at a profit, that there won't be new tariffs or new interruptions in their business. And all these expectations become under question when you have these kind of trade conflicts where the next step is unpredictable. And so people, number one, they start being more cautious and just doing less risky things. And the second is they may be losing money on existing trades, in which case some of the financing then becomes jeopardized. The cost of financing might also go up because the creditor is going to look at it and say, hey, I was financing trade at maybe 3% lending rates, and now I've got to think about 4 or 5 because my risk is higher, that maybe who I'm lending to won't be able to pay back. They won't be able to realize the business that they borrowed to do.
Definitely, that makes sense. I mean, that's why the real economy of trade and production are very interconnected with financial economy of
That's right. Finance is, some people look at finance as sort of something added on, something extra, something apart from the real economy. Economists often teach it that way, but that's wrong. Virtually all the real economy is financed. Even daily things like payroll for big companies, they typically don't have the cash on hand. They borrow it short term and pay.
Right. Well, I came across one very important question that I think I found from Bloomberg. It says that if a financial crisis sets up such a powerful vicious circle, why does it not lead to a total collapse? Why is always bottom there?
Well, that's because there's always, that's really inherent in the notion that there's division within the financial and investing community between bears and bulls, because bulls are the ones who've gone all out to favor an expansion. Bears are the ones who have kept some capital in reserve. So when prices are falling, when you're in the middle of a crisis and you've got a lot of things that are going down in price, obviously some people who own those things are losing or they're having to sell at a loss. But other people who have capital in reserve, that is the bears, now they're seeing a buying opportunity. They've got capital in reserve, they have liquidity, and prices are falling. At some point they're going to say, the prices got low enough, now's a good time to buy them. Essentially buying everything at a discount. In 1929, stocks fell an average of 90%. Can you imagine buying something on a 90% discount?
Wow.
Eventually it reaches a point where the price looks good to those investors that still have reserve capital to buy back in.
Well, if bears can end the crisis, is it possible to prevent altogether any sort of periodic crisis necessary?
Well, that was sort of the dream of Keynesian economics, that you could somehow manage things in a way that would prevent crises. But I think we found out that it's too difficult to do, in part because what some have called the animal spirits of capitalism, the audacity of the bears and maybe the rapaciousness of the the audacity of the bulls and the rapaciousness of the bears has always got the upper hand over any kind of effort to moderate and manage the process. Because when bulls are making money, the temptation to borrow and invest is so great. You can't resist it. A lot of people can't resist it. And if they were to resist it, they'd miss out. The people who borrow and expand, the Amazons, let's say, of the 1990s boom, there were many failures, but then there were companies like Amazon that borrowed like crazy and expanded fast, and they made a go of it. Right? So in every bullish expansion, you've got people who borrowed and expanded fast and won. You've got others who borrowed and expanded fast and ended up in the dustbin. But that's exactly how capitalism works. It doesn't work with moderation. It works with extremes. It works with extremes first of debt and rapid growth. That's the bullish side of it. And then it works with the other extreme, which is the economy is overheated. This is an expression that the bears use. The economy is overheated. We've got to pull back. We've got to retrench. And so now's the time to cut credit, to be more conservative in lending and let prices fall back to a more natural level. Well, there is no natural level, but it's a kind of game of back and forth to determine the contest between bears and bulls to determine what is the direction of the economy. It's
Right.
always going to be up in the air. It's never going to be something where it can be carefully and measured and regulated the way the textbooks would suggest it should be.
Right. It's very interesting. What about this year especially? Could a crisis be averted by a government action? Let's say the Fed, lowers the interest rates. A lot of people talk about that.
Yeah, well, typically that sort of action, it's particularly if you're near the end of a debt boom. If the Fed were to lower interest rates, it's sort of like throwing gasoline on the fire. You're going to encourage people to borrow, and yes, you may put off the crisis for a little longer, but then it's likely to be bigger when it does hit. Because what you're doing is you're just pushing up prices to an even more unsustainable and vulnerable level. And if you're using abnormally low interest rates to do it, a lot of bears are going to look at it and they say, oh, these people are borrowing money at unsustainably low rates. They're doubly vulnerable, because as soon as those rates go up, they're going to find that whatever they borrowed the money to buy, it's not going to be worthwhile anymore. It'll probably make the crisis harder, though it could delay it if there was an excessive expansion. That's why a lot of people who are in the Fed watching business say, well, we need to have a little bit of increase in interest rates now to slow down the expansion to make sure it doesn't become a bubble and then a crash.
Right. Well, the way that you say the story, it sounds like the Fed works for the bank more than people.
Well, it does, because the Fed as a formal institution is largely composed of bankers, the staff, and the owners of the Federal Reserve System are the big banks. It's not actually owned by the government. People don't realize that, but
right.
It does take a lot of its cues from stabilizing the banking system in the interest of the bankers, but it cannot really prevent the competition, first of all, to create an expansion, and second, that create a crash.
Right. I really wanted to ask a lot of questions about the trade war, as you mentioned earlier. It's sort of like a background of the pending financial crisis. But let's save the topic until next time, since we're out of time right now. Folk, remember to visit the website called Polarizing Political Economy to learn more about trade, financial crisis, bulls and bear dynamics. See you in our next topic, trade war. Bye-bye.